Hello, Professor Giametti. We're talking here in lesson number 15 about financial statement analysis and long-term financial planning. I'd like to start off by just reintroducing what we already know, and that is the balance sheet, A equals L plus OE, which is the financial status of a business as of a certain point in time. It's a snapshot. Income statement, revenue minus expenses to give us either net income or net loss, and that covers a period of time, usually 1 year. Talking mainly about ratio analysis here, which is taking these financial statements, components of it, dividing out certain numbers in each of these financial statements into other numbers in these financial statements to come up with fractions that we can compare between companies, within an industry, or just compare as a whole. Okay, three types of analysis that we do, ratio analysis, is trend analysis, which is year to year, evaluating performance over time. Okay, have our sales gone up? If so, by what percentage? Okay, then we can take a cross-sectional analysis, which deals with different firms compared at the same point in time. Okay, so we take GM versus Ford, for instance, and say, okay, what are we comparing? Let's compare various ratios, okay, in those types of firms, right? And industry comparative is to compare, like, General Motors to the overall industry. What are their cost of goods sold relative to the entire industry's cost of goods sold? Things of that nature, okay? Now, there are 5 types of financial ratios. The first type is liquidity. Liquidity measures the ability of a firm to pay its debts when they come due. Basically, short-run debts. Okay, and this relates to what we've already talked about before, I'm sure, in other classes: the current ratio, current assets divided by current liabilities, and the quick ratio, which is your cash, your marketable securities, and your accounts receivable divided by your current liabilities. This measures your ability to pay debts within a 1 year, relatively short time period, your immediate ability to pay debts off right away, and your average payment period is your accounts payable divided by your cost of goods sold divided by 365. This gives you how much it takes in days to pay off your accounts, okay? Average payment period, okay? The second type of financial ratio is your asset management ratios. Those ratios basically say, how are your assets being utilized to create sales? Okay, so we have our total asset turnover ratio, which is our net sales divided by our total assets. That's assets there. We have our fixed asset turnover ratio, which is our net sales divided by our fixed assets. Fixed assets, a component of our total assets. We also have our average collection period. Okay. If you're using your assets appropriately, you try not to make it too long to collect your receivables. Accounts receivable divided by your net sales divided by 365, the number of days to collect your accounts receivable. Okay? And inventory turnover is how effectively your inventory is being managed. This varies. It's your cost of goods sold divided by your inventory. For a firm like John Deere, who has large ticket items, it's going to be difficult to turn their inventory over quite rapidly. Maybe 2 or 3 times a year is all they look for. But in a firm like McDonald's or Burger King, they're looking to turn that inventory over quite rapidly. Within a week, certainly, they're looking to turn that ratio, that inventory over. Okay. This is part 1. I'm going to turn it over to continue part 1. Again, we're dealing with the 5 types of financial ratios. We dealt with liquidity and asset management. The others are financial leverage ratios, which is how much borrowed funds are used to finance your assets, and the ability to meet those long-term obligations. Okay, so there are basically 2. Total debt to assets, which is simply that, total debt divided by your total assets. What percentage of your assets are being financed by debt? And the other one is your interest coverage. How many times you can pay your interest. And that's calculated by taking your EBIT, earnings before interest and taxes, and dividing by your interest expense. In terms of profitability ratios, all right, which is the fourth type of financial ratio, is the ability to make a profit on the assets, equity, and sales being employed. Okay? Our operating margin is our EBIT divided by our net sales, which is basically your profit margin before your interest and taxes. Your net profit margin is your net income divided by your net sales. Okay? That is the old profit margin. When you hear profit margin, that's what we're going with. Return on assets. This is the amount of net income you're making on the total amount of assets that you're employed. Okay? And your return on equity is your net income divided by the equity. That is your assets minus liabilities. Okay? So there's your difference. The market value ratios is the value of the firm has in the market, in the stock market, relative to its financial statement values. So we have the price-earnings ratio, a very important ratio, which we also call the earnings multiple. How many times are you paying for the earnings of a company? That means what is the price and divide it by your earnings per share. Price per share, earnings per share. Simple calculation, but very highly used. Price to book value ratio. This is simply the same value, the price of the stock of one share, divided by the book value of your net assets, okay? Assets minus liabilities, divided by your common shares outstanding, okay? These represent the ratios. You should become familiar with all of these ratios. When you look at financial statements, it should become very second nature to look at these financial statements and extract those ratios to determine how this firm fits in with these 5 different ratios. Thank you.